Good morning or good afternoon, everybody, and welcome to our third midday on a Monday, 6th of April. We're 3 weeks in. We started this 1 week after sort of work from home as such. So as I said, it's 3 weeks. Welcome. I'm Matt Katz. I head up the corporate finance team at Buzzercott. The corporate finance team, there's 12 of us. We're multidisciplined. We support businesses in raising money, selling, and having various conversations about forecasts and valuations. We're here at Midday on a Monday to talk you through all the things that have changed over the last week with regard to the economy and some of the government support schemes. I'm ably supported by my team. We've got, in no particular order, Alex, Andy, PJ today. We've also got Doug from our HR Consultancy team, who's going to have a quick recap. He made a starring appearance last week, and he's going to have a quick recap on what has changed in the job retention scheme. So as I said, there's me. I'm going to just talk about where we are and just trying to put a positive spin, getting fitter to fight back. Doug, PJ, and Alex, and Andy is going to contribute, and he's going to talk about the effect that all of this has had on business value. And Andy is the guy on the team who's plugged into all the PE houses and the VC houses, and therefore has a really good take on what they're doing. And then I'm hoping, although he hasn't quite joined yet, we're going to have Tim Hastings from Ford Hastings, who's going to give us a bit of an insight into how the interim FD non-exec market is going, and how it's actually a great opportunity to try and get some extra experience into your business. And so he and I were going to have a bit of a chat about that. At the moment, it's going to be a one-sided chat. But we'll see if we can get hold of Tim. So cracking on as to where we are. I'm going to sit up a bit, make myself a bit taller, and also I've got the bookshelf going again. I've moved it around. Some of the books are below my computer, so it's raised me up. I've also bought my favourite book from university, Principles of Corporate Finance by Brearley Myers, that I read 25 years ago. I think it's all still roughly relevant now, but to be honest, I haven't opened it up. Back to charts and where we are. Last week I shared with you the Kubler-Ross model, and I think it's still relevant. And I think probably where the UK right now is, and probably many entrepreneurs, is probably in the depression slot, where we're now in this new norm. All the excitement of working from home, change, etc. It's now right. We've got to actually do something about this now to pull us forward. At the same time, at some levels, and if one is tracking the FTSE, this morning was a good morning, because the hope is coming back in Italy, France, Spain, and Germany, that the level of illnesses and deaths has got far lower. But the hope's still there, and one of my fears is that we're in for a bit of a double dip. And so now what we've got on the screen, is, hopefully you can all read it, and I'm just going to change my other PC so I can just about see it. It's some GDP forecast from the good guys at Capital Economics, and in there, if you can find the UK line and you look at Q2, that's minus 15% GDP, which even if you're not an economist, I'm going to show you another slide in a minute, not just yet, but in a minute, minus 15% is an enormous drop off in GDP, and that's just a forecast, and that's only just started, as such. It really depends upon how long we're all going to be locked down. And so, but on there you can see the other countries, and where the UK is the you've got Italy there at minus 20, you've got the whole Eurozone at minus 18, but this is going to cause catastrophic damage. So moving on, just to try and quickly put that into context as to how GDP has looked historically, and one of the bellwethers in this is the Purchasing Managers Index, which is the green line on here, and you can see that at the moment plummeting, and that was for March, and we're only like halfway into this in March, and so one's going to expect that to keep on going down. And just quickly putting the 12% negative GDP quarter and quarter into context. Back in 2008, you can see that chart there. We hit the lows of minus 2.4%. It goes to 12% or 15%. It's an enormous number to be down by. On the positive side, once we've had the down, we're going to have the up, and the ups are going to be massive. And so the press are going to have lots of, this is record-breaking growth, etc., when we return. And I think moving on to talk about the returning. And this is just my sort of final chart, just to illustrate where we are. So this is one I picked again up from Capital Economics. Passenger traffic in China, and using China as the closest comparative to where we are. We're now beginning of April, probably where they are at the beginning of that beginning of February, and you can see the different lines here, and the 100% line being the norm. Year on year, you can see that in the first half of 2020, or the first few months or so, that it was way above the like for like. Still 2 months on from their low, which is probably where we are. Even their best, the congestion in their cities is still 20% down from where it was. So enough of the doom and gloom as such, because what this section is about, it's opportunity out of adversity, and as an entrepreneur in a business owner, it's making of it what you can, and it's thinking agilely. And we've got the guys here who are about to take over from me, but just in terms of a couple of really good sources of information which are worth looking at, and we might be able to post this in the chat, but we'll definitely circulate around the information later. Obviously, you've got the very fine Buzzercott website, and we've got our COVID-19 section, which we're trying to keep updated on a daily basis. For some of the schemes, and the coronavirus business interruption loan scheme, actually, the British Business Bank website and has got some really good detail on there, and it is well worth looking at if you're considering getting that loan. But do come and speak to PJ and Alex first, though, because they've got better insights on the website. And finally, the businesssupport.gov.uk website is another great website which actually quite clearly communicates all the options available. So before we crack, my final tips for entrepreneurs, I said this last week, I'm going to say it again this week: keep all the cash you can in the business, take advantage of every scheme you can, be decisive now. Think about tomorrow, and this is going to be a long haul, so the actions you make now will have a positive effect later, and and innovate quickly. And I think we've already seen that across whole parts of the UK economy, about innovation and change, and accepting that the world is going to be a different place. So that's enough from me. So I think I'm going to hand over to the very fine Doug Farrow to give us a quick update. Doug, morning, Doug, or afternoon.
Good afternoon, Matt. Yes, I'm here.
No, great to see you. And so to crack on, I think the purpose of this isn't to go back over the whole job retention scheme, because I think various of the viewers are familiar. But there've been a few changes that bring some more clarity. That have been going on, I think, over the weekend, that have been keeping you busy, Doug. So do you want to fire away?
I certainly will. Well, good afternoon, everyone. And as Matt has said, I'm not going to go through all the basic details of the scheme. My objective is to update everybody on what's been announced over the weekend. And if I'm honest, there's a lot of confirmation, but there isn't a lot of new information that has come out. Some points have been clarified, and it's those that I want to run through. So the basic point remains: you can only claim for furloughed employees that were on your payroll on or before the 28th of February. And the information has confirmed that employees hired after the 28th of February cannot be furloughed and claimed for in accordance with the scheme. One question which we've been asked, and it's been answered now, although we guessed what the answer would be, and that is that foreign nationals are eligible to be furloughed, providing, of course, they were on the payroll on the 28th of February. It's also clarified that apprentices can be furloughed in the same way as other employees. But if they do continue to train, as we said last week, then at least they have to be paid the apprenticeship minimum wage, national living wage, or national minimum wage whilst they are training. It's clarified a point about shielding employees. You can claim for furloughed employees who are shielding in line with public health guidance if they are unable to work from home and you would otherwise have to make them redundant. And I think that is the key point. If they are unable to work from home and you would otherwise have to make them redundant. Now, we have to be careful with the terminology of this government update, because it's a Treasury update and it isn't in line with employment law in a number of areas. And one of the health warnings, I guess, is that although terms like redundancy are included in this update, advice that we've received, webinars that I've been on, that we've been advised that we have to be very careful and to make certain that redundancy in Treasury terms isn't exactly the same as redundancy in terms of contract law. And in Treasury terms, redundancy would include anyone who goes on to unpaid short-term working. So although it says redundancy, for the purpose of contract law, we can allow this to be interpreted as short-term working or no pay. So shielding employees, if they're unable to work from home and you would otherwise have to make them redundant, put them onto no pay, short-term working, then you can furlough those employees. Similar point about employees who have caring responsibilities. Employees who are unable to work because they have caring responsibilities resulting from coronavirus can be furloughed. Confirmed also that employees can be furloughed in one job and receive a furlough payment, but continue working for another employer and to receive their normal wages in that other employment. It's got a new section, the guidance have a new section on office holders. Now, the straight employment definition of an office holder is extremely complicated, and I don't want to get into that in this session. But in short, office holders can be furloughed. Anyone that wants to talk more about an office holder, I suggest that we do it offline, because that is a specialist area. The point about company directors has been clarified. We always thought that a company director, even though they were furloughed, would be able to continue to fulfill their statutory obligations. And that point has been made clear in the update that's come out this weekend. As in fact, salaried members of limited liability partnerships, they too can be furloughed. The process is slightly more complicated because there may need to be a formal decision of the LLP to reflect the fact that the member will no longer perform work for the LLP during the period of furlough. That's another specialist area. Agency workers, we were told last week that agency workers employed by a recruitment agency, employment agency could be furloughed. That raised the question, well, what about employees who are paid through and are employees of an umbrella company? It's now been clarified that employees employed by an umbrella company, they too can be furloughed. Well, once again, there's some more specialist advice or advice relating to a very special set of circumstances in the public sector, which could well affect academies. I was involved last week in advising an academy on this. And once again, it's not something I want to go into in this webinar, but if anybody within the public sector academies wants further advice, then please contact me. Thankfully, this update makes it clear that an employee who is furloughed must confirm in writing. That's never been stated before in the guidance. We know from contract law it must be confirmed in writing, but that's never been stated in this guidance, and it is now stated. A point which will need further clarification, I think, particularly in relation to what I was saying about contract law and information from the Treasury. The update says that claims should be started from the date that an employee finishes work and starts to furlough, even though at that stage they've not been written to confirming their furlough status. Now, I think we all know that what we've said before is it's very important before you furlough an employee that you do get their agreement in writing. So although the update says that you can furlough an employee prior to getting their written agreement, contract law says no, you can't. So I think we have to stick with contract law. Otherwise, we could be storing issues up for the future. Equally, there's a section in this update talking about past overtime, fees, commission, bonuses and non-cash payments. And it says you can claim for any regular payments you're obliged to pay your employees, which includes past overtime fees and compulsory commission payments. Now, it's suggesting that instead of getting the full 100% of previous overtime and compulsory commission payments, it will only be at the 80% rate. So there again, under contract law, we have to make certain that any agreement we have with the employee in a situation where they're entitled to overtime payments worked in a previous month, commission payments worked in a previous month or quarter, that the written agreement covers that those will be paid at a reduced rate. Otherwise, there could well be contractual claims going forward in the future. Just coming to an end of it now, any employees you place on furlough must be furloughed for a minimum period of 3 consecutive weeks. And I think we knew that before. Employees can be furloughed multiple times, but each separate instance must be for a minimum period of 3 consecutive weeks. That is a new point, and it answers a question about whether you can take an employee off furlough and then put them back onto furlough. And from reading this guidance, yes, you can do that. You can take them off furlough for a time and then put them back on, providing when you put them back on, it's for a minimum period of 3 weeks. So what doesn't this answer? Well, it doesn't answer the situation where a firm might have been TUPE'd after the 28th of February. So you've got, for employees who've been TUPE'd across to another organisation after the 28th of February, at present, they can't be furloughed. And one of the questions that's being raised a lot with us is the TUPE effective date was 1st of March. Can we now furlough those employees? And the way it stands at present, no, they can't be. So we are waiting for further advice on that one. Finally, can annual leave be taken whilst furloughed? ACAS says no, or advising no, it can't. Other employment lawyers are saying yes, it can, but if annual leave is taken whilst furloughed, at what rate? And this we're waiting for confirmation. So back to you, Matt.
Brilliant. Thanks for that, Doug. And I think, Doug, you've done something very clever there, because someone on the line, everyone, apologies, I think I've failed to tick a box which allowed you all to ask questions as we went along. At least I can't find the question panel this time around, so either Microsoft have disabled it. But what Doug has done there is he's, I think, asked a lot of the questions that I know that we've been asked, over the last week or so, which we didn't have answers to. So thanks a lot for that, Doug. And I've got a couple more questions which I will save for the end that I can ask you. In the absence, or in my entire failing to get the question boxes working, or Microsoft's failing, please do email any questions you've got, and I've got access to it to corporatefinance@buzzercot.co.uk. So please do just send an email if you've got any questions. And as before, if we're not able to answer your questions now, we will get back to you afterwards. So job retention scheme. Thanks, Doug. That's obviously moved on and changed, and I have no doubt that we'll be back and it will change again. But Alex and PJ, the CBILS, the Coronavirus Business Interruption Loan Scheme. That's a great name. That's also been evolved and changed. So this is now the fourth innovation that the government have brought in. So I think, PJ, you're going to fire away with what's new in it.
Yeah, morning everyone. I think there's the stuff that came out over the weekend, and Alex will go into a bit more detail on exactly what's changed and what this means for anyone doing their applications. But I think there's been a bit of a disconnect in between what the banks are requiring and what I think businesses actually have been supplying them, and what the advice has been. I mean, 1,000 loans out of 130,000 applications isn't a stat line that anyone's going to be proud of. And I think we've seen that with a lot of businesses we've been speaking to and helping. For example, one client has been affected by coronavirus through their supply chain, not being, and their working capital cycle, not being paid by their debtors, their customers, and then not being able to get products from their suppliers, and so they requested full 5 million from their bank to act as a buffer, because they thought we need to place a big order, but we don't know if we might get it, and that might be cash out the door with no products to pass on, and to use it for expansion, because they're in a sector which is doing well off the back of this. That was flatly rejected by their bank, because they couldn't show that they'd been directly affected yet through coronavirus. So we're looking into helping them establish and present that story so that they can actually get that through and over the line. But I think a few of the things that came out over the weekend and the guidance actually will help them and help a lot of the people we've been speaking to actually put forward and be able to access the money, or make it easier for the banks to actually give them the money through ticking all the boxes that the government require. So I think Judd's going to go into a bit more detail on that.
Brilliant. Alex, do you want to jump in? And just before Alex jumps in, some of us, I was pre-prepared sort of before this lockdown. So I got my haircut, so I'm good now. We're 3 weeks in or so, I'm okay. But Alex has taken it to the extreme and freshened himself up over the weekend. So sorry to interrupt the flow, Alex, but over to you.
Yeah, thanks a lot, Matt. So just following up on what PJ said, just kind of generally the market, there have had to be some kind of significant changes from the Chancellor, from Rishi, about these loans that he's offering. And the first stumbling block is, can you show the changes, Anna? So the first stumbling block was that actually the banks didn't need to provide the loans on the terms of the loan scheme if they were viable to get normal loans in the first place. So people were applying, and then the banks were saying, yeah, well, fine, it's ticking the boxes for a regular commercial product, so we can offer you that. And they didn't have the favourable terms that the business were looking for. So just adding kind of an extra step. So this is now being removed, and essentially removing one of those barriers for people to be able to get the loans. But I mean, there is still the same kind of viability assessments, and the criteria hasn't actually changed. But it's just the fact that the banks are kind of being more encouraged to offer these the CBIL loans rather than their normal commercial terms. The second one is on the small side only, but it's removal of the personal guarantees. And this is something that people were just getting very kind of worried about, putting their kind of houses and mortgages on the line for a very kind of unknown market, and really didn't know what they were getting themselves into. So the government have removed this on the small side, and We have also had a lot of conversations with banks, and they do look at this on a kind of case-by-case basis. So there are various negotiating terms, and things are different from person to person. And then the third one is the larger scheme. So it was initially only for businesses up to 45 million turnover, and this has now increased to businesses to 500 million turnover. And the total loans has gone up from 5 million to 25 million. So again, it's the chance of being aware that this is affecting everyone and larger businesses, and they're likely to apply for these loans. At Buzzcott, PJ touched on it. We offer a kind of product of, because we understand what the banks want and the kind of applications they're getting. We're offering a product to streamline this process, which it builds a story from the start to finish of, as PJ said, if there's a kind of weak story, you really need to have the evidence to show the bank exactly why you need this loan. And then we'll go through the whole process, but it takes you from kind of producing those forecasts to developing that, to actually reporting it to the bank, and then getting to that negotiating stage. That's pretty much it.
Brilliant. Thanks for that, Alex. And I suppose a question right up front from myself now. For the large companies, because there was a big gap before, so we had this up to 45 million pound turnover, and then the sort of effectively the proper credit rated PLCs. Do we know, is the rules for those above 45 million, is it exactly the same as those for below 45? It's basically, other than the loan being bigger, is the test still the same? Do we know all those details yet?
I mean, I don't think all the details have come out, to be honest. It's just been announced that these are the new limits, and as far as I can tell, it will be the same criteria. So it's really just having the forecasts showing the exact impact of the coronavirus, and presenting what the business as usual case is, and that you can actually repay the loan. Because I think that's been the point throughout, which a lot of people have missed, is that this is not just free money and a free loan, and this all sounds great. The banks do still consider their normal commercial circumstances for it.
Cool, excellent. Thanks for that. And I think there are. I can see there's been a couple of emails through to the corporate finance web address, and I will pick up those questions shortly. PJ, have you got anything else to add in terms of, before we move on to Andy to have a talk about valuations, in terms of how the banks have been inundated with with applications. How is their day-to-day process with dealing it actually working at the moment?
So I think that they've been inundated, and I think they've been, my understanding is that they've been reviewing everything, but if there are some which don't have sufficient detail around, and I know a lot of them have standard forms which you want to fill out, and it looks like, okay, that's all the information you need to provide, but I think it's better at this point up front to provide more information than less, because they have so many applications, they are dismissing some which may have merit purely because it falls in the too hard to do to try and draw out all the information that they need. And so I would be tempted to over provide information on the first port of call, because in the background behind their kind of standard template, they will have a longer and far more detailed credit application form, which they'll need to put all the details in, because as Alex said, they're still going through their normal commercial processes in terms of determining whether the loan can be repaid, etc. So I would definitely err on the side of providing more information than less on the first application.
Cool, brilliant. Well, we'll return, because we've got a few questions around that. Apologies for my camera resolution. I think my kids, now they're fully ensconced on their iPads, and as many screens as they can get hold of are using all the bandwidth up in my house. So apologies for that. We've got the government schemes, and as I said, on the government's business support website, it's got details of the others. And as the month trots on, oh, happy new tax year, by the way, everybody, for those who are interested in new tax years. But on that point, if you haven't, if you're thinking about you might need some more money, do think about deferring your PAYE, slightly later in this month, because this is one that you need to phone up in advance and ask for. So, do have that in your mind. That's the world has changed a lot in the last 3 weeks since we've started doing this, and but there are still transactions going on, and value, and for I know it for many it might seem a long way off, but making sure that one has still got a valuable business is all part of the purpose of being an entrepreneur. Andy, as I said earlier, has been fully plugged into the VC and the PE markets and the like, as well as he's got a great understanding of even in this short term how valuation has changed. So Andy, do you want to kick off into give us a few insights on that front?
Yeah, sure. So again, to probably build on what Matt said, in terms of context here, is probably for a number of people it doesn't feel like valuation is top of the mind, but we've actually been speaking to quite a few people whereby the view has been either people have been in transactions and they've fallen over and they want to understand what's happening with regards to valuation, or actually off the back of this have been considering doing acquisitions or raising finance to help the business grow or make it through its time from equity providers, all of which has an impact on valuation. So those are the rationale and the reasons why. There's a really simple formula on the screen, but just to quickly talk and break down the components which come to build up a valuation for a business. Most businesses, unless we're talking early stage when there's perhaps not profitability and we're talking about a revenue multiple, most businesses it's applying the EBITDA and then applying a multiple of that EBITDA, which represents broadly what the future cash flows of the business will be to get to a valuation. The reason I do this is actually for businesses right now to understand what your value is, you need to kind of think about the two different perspectives. If we focus on EBITDA, which is earnings before interest, tax, depreciation, amortization, and casually in the market, I've actually saw somebody showed me one last week, one of the first information memorandums that had EBITDA Theon, which is for coronavirus. That is pertinent because actually right now, if most businesses were looking at what's my trading in the last couple of months, it's going to be far lower than this time last year or the preceding months up to it. So it's think about what the purpose you're doing is. So actually I take two juxtapositions of where EBITDA could present in very different ways for different purposes. So if somebody's actually going for an EMI valuation at the moment, which is to give staff options, actually now is quite a good time because there'll be a good argument that your EBITDA is lower and you could present your EBITDA as the last 12 months of trading, which is going to be far lower. If we go back, please, just on the slides for a minute. And then that actually will be important because when looking at that valuation where on the previous slide it had times the multiple, you'll have a lower number. And therefore actually having a lower valuation will be beneficial. However, for a flip side of it, if you're going out to raise money, can we just stay on the previous slide for a second? If you're going out to raise money, then actually having a higher EBITDA is going to be better because it's going to show the business performance more accurately without the impact of the current situation. So it might be a case of actually taking, say, the 12 months trading up to the end of February, which might present the best performance of the business in normal times because everyone knows, hopefully we don't know how long, but this will be a blip, and therefore taking one or two really badly performing months, especially if you're, say, in the retail sector where you might be having zero revenue right now, that's not fair to say you'll have on an ongoing basis zero revenue. There's probably also a backlog that might flow through when this is over as well. So it's trying to get a representative view of what the business is to apply a multiple. So again, it's thinking about what that number is, and I could go into a lot more detail on that, but we'll leave that there for the minute. In terms of the multiple, that's the levels of profit that somebody really how the business is performing. So there are a couple of different ways to look at that. Effectively, the trading on the stock market is all based on the same principle as well, that there's a multiple applied to the profits, and therefore actually you can see, if we look at the equity markets right now and the performance that Matt's been touching on since this all started, generally the FTSE 100, and I've picked the FTSE AIM share index because that's for smaller companies to probably more representative, are down around 30% from their peak before the crisis. Now, part of that will be because trading in the short term is lower, but equally it's a representation that the view of future earning potential is that it might be lower, and therefore the valuations have been knocked down, and therefore you might be expecting a multiple to drop at the moment. It's worthwhile saying that actually, if we go on to the next slide, that actually the variance though will very much depend on the type of business you have and the expectation of how the business has been impacting. So, you know, if you take Netflix on the left, obviously a business that's going to perform probably fairly well out the back of this is down very slightly, but it's only 6.7% down. You can see there was kind of a knee-jerk reaction there in terms of the trading on it, and then it jumped back up. Netflix aren't really releasing daily trading updates, so this is a representation of what people are expecting the future profitability of the business to be, and it's the market that's determining that. On the right, IAG is British Airways and a few other airlines. They're all owned under common ownership. You can see the difference there, that's down 68%, which is factoring in the fact they're earning no revenue for the moment, but also the uncertainty of how long this will go on and the future earning potential. So why am I talking about this and what does it mean? Well, it's impossible, to be honest, to say an exact, well, if you had a £10 million valuation before this started, you'll now be worth £7 million because there's a 30% drop. It's going to be based on a number of different factors for the business, but also the smaller end of the market. If you're talking around, say, taking private equity or venture capital money, and it is worth saying private equity transactions have pretty much stopped. So that's money coming out of a business. But actually, growth capital, which is money getting invested to a business that the business can use to spend and grow, those transactions are still happening. I mean, we've seen over the last couple of weeks, we know of a deal that's gone into exclusivity with somebody, and we know another deal that completed. Those valuations are probably going to get impacted. Nobody quite knows because there aren't really many deals going on for us to draw the comparisons of, is it a 30% decrease like the equity market is seeing, or is it higher or lower? Because actually, there's an argument here that can be used back with trying to raise this investment, that if you're looking at a 3-5 year horizon for an investor coming in to exit, that actually at that point, is the business going to be as strong as it was before this or stronger at that point? Because actually some of the competition might struggle more than a funded business that has money in its bank account to go and spend on marketing, say, when this is all over. Unknown, and therefore it's impossible to say it's a straight line adjustment, but I think it's worth thinking about your particular industry, how you want to present yourself, and then how that will be perceived in the market. So that's a really whistle stop. That could go on for this for probably a whole hour on its own, but I just wanted to give a quick flavour of what people are seeing in the market at the moment, which if you want me to sum it up very quickly, private equity aren't doing deals for cash out at the moment. Growth capital transactions are still happening, and there will be an adjustment to price, but it will be very specific to each business, their sector, how they're operating and how they're trading. But presenting your EBITDA and the strength of the business to improve that multiple is the key right now.
Brilliant, thanks, Andy. And I think just to, in terms of a couple of valuation things, I've got a question for you as well. But I think just advice to clients, because valuations are volatile, and we've said it several times. Now is a brilliant time to be thinking forward about EMI schemes and getting those in at low value so they can be the biggest possible reward for the staff and for teams. The other area, and as a corporate finance team, we do quite a lot of work with our tax colleagues, is tax restructuring, where one might be able to shift trades out if you've got trades and properties locked up in businesses at the same time and you want to separate them out without creating too many tax charges. Now is a great time to do it, because in theory values are low, and one can have the conversations with HMRC about value being low. So those are two two areas just on the valuation front to think about. I did have another question for Andy, but it's completely slipped my mind. So we will move on. Well, we were going to move on. And Tim Hastings from Ford Hastings was going to join us. He's probably lovingly watching us from the other side as such, but Tim hasn't been able to get on board. And I think what Tim and I wanted to talk about was about getting more experience into businesses, and one of Tim's specialisms is getting the right non-exec and the right interim FDs in, and that's something that's very close to my heart as well, in terms of when business is good, there hasn't been a need to invest in sort of some of the grey hairs in business and in some of the financial systems and processes. I think when it becomes tough, that's when things start to be more telling, and we will get Tim back in future to talk about exactly what he does. But on our side, what are we doing with several of our clients, and we're doing it already, and we will keep on doing it. And it's sort of the good practices that we do and it all sits around forecasting and cash flows, and it's getting in there, and it's taking what one might have, which might be a cash flow, whether it's a monthly cash flow or a yearly forecast, and actually sort of bringing some proper science and calculation to it, so you properly know where you're going, so you can react accordingly. And to be honest, majority of our clients probably reacted more pessimistically, thinking the world is about to end. But actually, when you sit down, you look at the schemes available, you plot it through, and there is a decent amount of cash in many businesses, even in those sectors where the business has almost come to an end. So it's so we help you guys create those tools, which are infinitely valuable in situations like this, to be able to make the decisions. Do you furlough? Do you have to make people redundant? Do you just shut up shop completely and sort of mothball it and then come back 2 or 3 months later? But it's so what and at the same time, and I know that in Tim's world there are a lot of really good people around who are willing to invest their their time and effort in return for future rewards as opposed to current rewards, acknowledging that that cash isn't as free flowing as it might be. But do as an entrepreneur, open your minds to what external help you can bring in, because if nothing else, an extra pair of eyes and ears and everything brings some. It's someone else to talk to. Because often running a business is a lonely experience, and it's good when it's great, but when it's bad, having that support is invaluable. And that's the same way myself and our team. We're here, to have conversations, with yourselves. So please do, pick the phone up to us or drop us an email. Whenever you want. But so we'll get Tim back another time. So on to the questions, and so just I'm going to jump on to Doug first, and just I'm going to have to multitask. So I've got the questions on my phone now as opposed to a panel. But Doug, the question I had, the actual portal for the job retention, is it open at all?
No, it's not. If my memory serves me correct, it did say when this scheme was first launched, it would be open within a few weeks and payment would be made at the end of April. Now they're saying that the portal will be open, quote, we expect it to be available by the end of April. So it's going backwards.
Okay. Fine. So there's a good likelihood there's still going to be quite a big. So the portal will be open, and then the money, could easily be another month, maybe.
I think it's going to be end of May at the earliest, because HMRC has got checking to do, and the latest update gives a little bit of information about what checks that they will do once the claim has been made. I think we all know that they're going to be inundated when the portal goes live. I think it's going to take a few weeks before we see the first payment. And the fact they're saying we expect it to be available by the end of April, that concerns me.
Okay, fine. So there's a good likelihood there's still going to be quite a big. So the portal will be open, and then the money, could easily be another month, maybe. Okay, cool. Because it's and again, just going back to some of my other things about how long this might go on for. If one follows the China model, there are we could easily be sort of locked down in sort of underperforming world for another couple of months, and therefore it is important, if one has been banking on that job retention scheme money, that one is actually thinking plan for getting it at the end of May. So you need to make sure you have got a bridge. And one of the questions, and although I one of the questions is, can one delay in paying the employees? I suppose in theory, if you haven't got the money and you have to wait until the end of May to get the money, and that's all the employee's going to get, then then in theory, I suppose one is delaying. But I think, Doug, you probably agree. The best practice is keep on paying your employee and get the money back from the government later. Is there any?
Certainly, the best practice is to pay the employees at the time that you're contracted to pay them. If, though, finance is tight and some employers are unable to make the April payment before they receive the money from the government, then it's a matter of going back to the employee, telling them, and getting their agreement once again in writing. This is the key thing, that if employers are forced to make a change for good reason, they must get written agreement from the employees to make that change. And if they don't, they are wide open to a lot of claims, breach of contract, withholding pay. All these claims could come in during the summer months, which employers will not want. So I strongly advise employers to always get written agreement when making changes. Cool,
brilliant. Thanks, Doug. So a question from one of our other fine clients. This is going to be on the coronavirus business interruption loan scheme. And actually, this very fine client has also sent a photo of their bookshelf with the same corporate finance book on it. So I don't know if that's good or bad, but they've got the application form from their bank for the coronavirus business interruption loan scheme, and their bank has got sort of 12 boxes for extra information on. I suppose, PJ or Alex, what's our advice in completing the sort of extra information? Should one go light up front, or should one go heavy in the detail as such? What's our view on that? PJ, do you want to shoot me an answer?
Yeah, I think this comes back to what I was saying earlier. I think you want to go not overly heavy, but you want to provide them with enough information at this point that they can make a proper decision. And I think it needs to line up with the story that you're trying to get across to them. So I would err on the side of more information than less at this point, but it does need to be clear and cohesive. It's not just dumping all of the your management accounts and loads of page after page of your business plan as such in there. It's getting them the right information at the right level of quality, but I would definitely err on the side of more than less at this point, just to arm them with enough that they can actually go back to internally and make the argument, so they've got enough information.
Yeah, cool. And I think lining up with PJ with that, one of the, for one of a better description, philosophy or whatever we share with our client is about, and we call it the story, and it's about getting the story right. But it's not about telling a tale or anything. It's about making sure that the words and the numbers work together. Because I think probably one of the biggest failings that we see is often actually the word story works, but the numbers don't usually quite follow that story in the same way. They cut corners, or they're just sometimes completely inconsistent. Would you agree with that, PJ?
Yeah, we see that quite a lot. So people, I think, find it easier to verbally overlay the story of what's happened to the business, how you're going to tackle it, and what the future holds. But then once you dig into the assumptions of what, say, the forecast says for the business, it doesn't quite add up, and that's the bit that when we're having conversations with all of the banks, that they really struggle with is, okay, fine, yes, we believe the story, but once you run the numbers, it doesn't stack up, and therefore we can't turn around to their credit and say, oh, these guys, they know what the issue is and they've got a plan to get out of it, but it's not demonstrated, and so they can't go back internally and say, oh, this is a good one to lend to, because there's only half of the good quality information there.
Cool, brilliant. But another question. Obviously, it seems like we move from the phases, because the last couple of weeks, Doug, or the coronavirus, the job retention schemes, we're very important. There are many more questions on the loan scheme. This week, which probably shows that the business have now moved from the sort of shorter term things to the longer term things. So, PJ, Alex, if one lender turns a business down, can the business approach other lenders for the scheme? Do we PJ, Alex?
Yeah.
No, I can't see. I can't.
Yeah. So a lot of the banks are saying that this is primarily for their existing customers, and that's who they're concentrating on helping first. Now, based on the conversations we've had with our contacts at each of the banks, they're open to looking at new kind of introductions from ourselves. But I think we have properly had to have looked at it and analysed it, and we need to be confident that there is a real case, that we can say to them that there is a real case for them to get the loan scheme, because otherwise the general internal rhetoric is that actually it's just open to to existing customers only.
Cool, brilliant. And maybe, I don't know if Alex knows, just to keep the variety going. If Alex knows the answer to this question, or not, if one has already got existing debt in the business, how open are the lenders going to be to providing finance under this scheme?
We're not entirely sure, but essentially the lenders and the banks are looking at these as like normal commercial loans. So the fact that something new has happened in the business, if you can present the impact and then the future forecasts, there's no kind of cut-off reason why another loan would not enable you to get this, but you need to show that you can finance it.
Yeah. And I think related to that, and we haven't seen it evolving fully as yet, just because the lack of numbers going out, again, going back to the enterprise finance guarantee scheme from 10-12 years ago. Whenever it was, again, in the early weeks and months, that there was a very slow take up, because of the way it worked was clunky, it was new, and at the same time, the banks themselves were struggling. But what one, as we sort of reached that new norm back then, what one was able to start doing was to use it as a suite of debts. And so sitting there, so for example, I had a client where we had an overdraft facility, we had an EFG loan, and actually, and this was from Santander, and we also had some of their breakthrough financing in it as well. So overall, one had a very good blend of debt sitting in the business, and therefore, once one has reached that's a new norm, being able to use these this money in conjunction with other debt that one has got is it's about thinking about the whole structure. I think the other bit of advice that I would give, and as I said earlier, one of my tips about keep as much cash in the business as possible, and I think it was PJ that touched on it, was this is debt, and you only really want to be taking on debt, and if you can clearly see that you're going to repay it. And the reality is that if you're making if you go and borrow £2 million, and actually for the next 3 years you think you're only going to make £300,000 or £400,000 a year, that is all the money that you're making is going to pay that £2 million. and therefore you need to think, coming back to the forecasting and the cash, you need to think very carefully about what your new shape and size of business needs to look like to be able to sustain that debt. Because what you don't necessarily want to be doing is borrowing a whole load of money just to cover losses today if you're never going to make adequate profits in the future. So that was my thoughts. So digging back into into questions.
I just wanted to interrupt slightly. One of our team has pointed out to me that on the government website it says you can approach other lenders. I just want to clarify that whilst that is the case, the reality based on our conversations is a little bit different. So whilst the advice says you can approach whoever you want, that is true, but I suppose we're more interested in what's actually going on out there at the moment, and I think that the reality is a bit different as to whether you'll get any traction with approaching a new bank versus your current bank in terms of going for the CBIL loan.
Cool. So I've got a question on for Andy. As coming back to the just for the benefit of you, could you just reiterate sort of the difference between sort of the VC markets and the PE markets, and why they're, you know, the appetite between growth capital and sort of, you know, PE investment is, you know, is different right now?
Yeah, sure. So yeah, there's a difference in the maturity of the type of business that the private equity market and venture capital market will look at. So as a broad brush, I'd say venture capital is looking for generally unprofitable businesses, but they're on a fast growth trajectory with that story to reaching profitability at some point. But it's all about that upward curve, that trajectory that they're on. Whereas the private equity market is still looking for growth, but it's looking for more stable businesses, which usually means, you know, the smallest end of the scale some people look at generally is probably about £1 million EBITDA. So you're looking at slightly different levels of maturity on the businesses. Now, the key thing of why private equity right now, and I say right now, I think my gut says, depending on how long this goes on, second half of this year, transactions will start happening again. But right now, most people are on pause, is because the typical private equity transaction will have a decent, while there might be some growth capital going, there'll be a decent amount of capital going out to the founders and owners of the business. You know, in effect, if there's a whole or partial sale going on from shareholders, and in that scenario, the money from a check that the private equity firm are writing is going out into the pockets of individuals or institutions that own the businesses, rather than into the business growing. So there's no extra firepower, there's no extra ammunition to help them grow. Whereas in growth capital, the check's being written is more likely to be going into the business, and then therefore the business's bank balance is bigger, which helps it from a couple of perspectives, because one, it allows it, talking about the financing side of things, allows it to ride through the next month, 2, 3, however long this is going on for, much better than competitors who haven't got the same bank balance. And then also when we get to the end of that period of time, they'll be sat on a large cash balance, which can be spent on marketing in tactical areas, make most of any kind of backlog, but then also to gain up market share. It may be less of a competitive environment, because unfortunately some businesses might not make it through environment, so actually they'll gain a much bigger market share. So it's a very different dynamic. In one, both sides, a check's been written, but in one, it's going into the business, which helps the business strengthen, and in the other, it's going out to the pockets of people who already own that business. So that's why there's a bit of a difference in terms of the appetite at the moment.
And I think probably on that note, Andy, I think just to add as well, I think that there will be a scarcity of, you know, the good businesses that attract the VC and the growth capital investment, you know, right now, because, you know, sadly some of those you know, existing business models would have been turned upside down or whatever. But so you know, if you have got a business model that's working, those VCs are going to want to be speaking to you, and valuations, you know, as you touched on earlier, and you could still be pretty good, you know, for those good businesses. So I think we've probably reached our hour. So if okay with everybody, I will wrap up. just to reiterate, as a corporate finance team, and the whole of Buzzercott, we are here to help and support our clients, and therefore please don't hesitate to email us or get in touch with us about any queries. And if as a corporate finance team we can't help you, we will find the right team in the firm to help you, whether it's HR, whether it's VAT, whether it's PAYE. So please don't hesitate to get back to us and get in touch. As we very catchily called this Midday on a Monday, and this is the third one, and next Monday is a bank holiday, although we all absolutely love sitting in front of our computers and video conferencing all the time. We are going to give it a break next week, unless, of course, over the next 7 days, a whole world of things change. And if that does happen, we will come back and we will do Midday on a Tuesday. I know it's not very original, but that's what we will do. But right now, we're not planning on doing it, as we think that everyone needs a bit of a break over Easter to hopefully enjoy the sunshine and the like. But hopefully the last 3 sessions have been a really good insight for you all into what's been happening. Hopefully good for you all to, maybe if you haven't met some of our team before, to see some of the faces. But we will be back in a couple of weeks. Thank you all ever so much for watching, and I look forward to speaking to you all soon. Bye.